Welcome to Housing Matters, the Vancouver Real Estate Show. I'm your host, Stuart McNish, coming to you from the studios here at Oh Boy Productions in Vancouver. Today, we have 4 different guests with varying opinions about the federal government's forays into the housing market. First, there was the B20 stress test that took the legs out from under first-time homebuyers and sent shockwaves through that segment of the market, and many say had impacts that rippled on up through the market. Now, in what appears to be a recognition of the impact of the stress test, Ottawa, in its latest budget, introduced the CMHC First-Time Home Buyer Incentive Program, something the federal government says will allow more middle-income Canadians to fulfill their dream of home ownership by becoming joint owners of their home with their national government. Well, not so fast, say many in the real estate sector, pointing in particular to Vancouver and Toronto. They say that when you add in the maximum income of about $120,000 to qualify, you have to be under that, but you also still have to qualify for the B20 stress test. Well, under those circumstances, the only home you can hope to buy is one that is roughly $520,000 or less, and that is if you can find one. Now, just before we get to this fascinating topic, I want to give you a big shout out to our sponsor. This episode comes to you thanks to the support of Denby at Sandhill. Located in Langley's historic Murrayville, Denby is a collection of just 64 premier semi-detached townhouse residences, featuring homes up to 1,100 square feet, patios that let you expand your living outside, modern kitchens, ample parking and storage, and a walkable community that lets you live, shop, and play. Please check out denbyliving.com and join us for the public grand opening Sunday, April the 14th, and experience Master on Main Living for Yourself. Joining me now is Luke Ramsay, who, interestingly enough, works for a developer that attempts, in the mix of their offerings, to build homes for young families, the very people that the new home buyer incentive is targeting. He says that his company strives to build quality homes, which, no matter which way you divide it up, in Vancouver, end up costing more than the help the new home buyer incentive provides. Add to that, he himself is a first-time wannabe homebuyer grappling with the same issues of affordability. Luke, welcome.
Thanks for having me.
What's an average price that somebody would be looking at right now to buy one of your units? Let's say a 2-bedroom unit, if such a thing exists.
It's an interesting question. Right now we have 2 projects in Vancouver that are completing this spring, and 2 fairly different circumstances of build. One of them, we really had that first-time home buyer in mind. And so what we decided to do there was do mostly family-oriented units, so 2 and 3 bedrooms, but try and make them smaller. Make them smaller in terms of bedroom sizes that you can fit in the appropriate size bed, and there's room to maneuver, and there's closet space, open concept living space, but not pushing the boundary of too big, so that a first-time home buyer could go in and live in a space with, enough size, but they're not over their head trying to pay for something that's competing with a single-family home range.
Okay.
Yep.
Nice explanation about that place. What would that list for?
Well, like our standard 2-bedroom plan would be about 800 square feet.
Okay.
So at 11, call it 1,100 a square foot, because we have to sell the whole building. That would be about 880,000, I guess.
Okay.
Yeah. I mean,
that's a pretty hefty bill for a first-time buyer.
It is a hefty bill for the first-time buyer. It's a challenging market out there.
Right.
Yep.
And the federal government recognizes the first-time buyers, you got to get them into the market. And so they keep making adjustments. But one of them that made it even harder was introducing the B20 stress test. What was the response from people who were your potential buyers following the introduction of the B20 stress test?
Well, I think initially, the people who had already pre-qualified for their mortgages and perhaps weren't subject to that right away, they were eager to get in the market. And the people that qualified after, obviously, that just drags down what they can qualify for. And I think real estate in Vancouver is a big industry. It drives a lot of jobs. A lot of people work and thrive on that industry. And in some ways, they're kind of killing their golden goose by pushing people out of the housing market and slowing down housing by this policy. So they might be causing the problem that they're setting out to prevent.
Well, you would have felt impact by the introduction of the B20 stress test, did you not?
Yeah, I mean, where our targets were for sales started to move down. And working on the development side, not on the marketing side, I don't follow it quite as closely. I'm trying to deliver a really high quality project on time and on budget. But from the marketing side, it starts to get a little concerning when prices start to tick down because of policy. So
does the introduction of the equity partnership for first-time home buyers make any difference to you?
Well, listen, I mean, I'm I grew up in Vancouver. I like it here. I'm a young professional, and I'm looking to buy my first home.
So not only are you in this business, you're looking to buy your own first home.
Yeah, that's right. And I consider myself lucky to live in Vancouver and have a good job and those sort of things. But I would like if the government were to respond to those things and encourage people to live in cities. And what they've said by this cap on this income is that it's either going to only help people outside and or it's going to drive people out to commute. And I think more where we are now, where people are trying to be green, they're trying to be ecologically friendly, they want to walk or bike to work. This is going to start pushing people out who can now afford to buy something in sort of rural Vancouver rather than staying in the city. And so I see that sort of gap in the policy they've created that doesn't necessarily align with some of their other policies in terms of trying to create a sort of equal playing field for everybody.
What do you think they should have done? And I know that you're not the politician, but in talking to you already, I can see that you're a fairly thoughtful person and you have a broad perspective. How would you have addressed it differently? Knowing that you're wearing two hats, one the development side and the other is that you're a first-time home buyer.
Yeah, I mean, it's a difficult question. I'm not a policymaker and I don't strive to be.
No, but policies are driven by the opinions of the people who live in any constituency.
Sure. I guess one thing that would have been nice to see is government encouraging builders to build more through incentive programs like, we've seen some incentive programs in the past for lower interest rates for rental, for example. That's going to allow people to stay in the city at a lower cost of living. Doing a similar type program where they, as a developer, it's hard to lock in your interest rates as well. And we pay an extraordinary amount to the banks during construction, and that just gets passed over to the home buyer. So the government having access to sort of, I guess, large financial capacity, more than a bank would, they're flexing those muscles with this program. They could do the same by helping developers with lower interest rates and then ensuring that they pass that on to the buyer. Okay. I think if I'm wearing both hats, that would be the perfect world for me.
Well, that's pretty innovative, insightful thinking. And hopefully they're listening.
Yeah, well, we'll see. Yeah.
Because we do have a real need. We have to address affordable housing for people who are just like you, up and coming professionals that want to be able to live and work close to where they where they are, so that they're not going into those long commutes. Mm-hmm. I think it's innovative thinking, and hopefully they're listening, because we need to address this problem.
Yeah, I mean, for people everywhere like me, it's challenging to get into the market the first time. And as a developer, we're always faced with people putting up barriers to constructing new homes. And at the end of the day, the more homes, the more affordable things become. If we limit the amount of homes that are being constructed and people the demand goes down and the demand stays high and the supply goes down. Yeah. And so the prices are going to go up.
Exactly.
So if they create policy that helps more houses to get created, more homes to get built. I think that will overall help the affordability issue, and it will help the economy, and I think it will help everybody.
Great. Well, thank you for coming in and sharing that with us.
Thanks for your time.
Joining me now is Rob Regan-Pollock, who is even more firm in his determination that the Home Buyer Incentive Program will do little to improve access to ownership in housing for first-time buyers. Rob, you're the Vice President of the BC chapter of the Canadian Mortgage Brokers Association. Welcome.
Yeah, thank you.
You're in the mortgage business.
Correct.
You're seeing a tremendous amount of changes right at the moment, partly because of the fluctuations in the market, but also based on what governments are doing. And the most recent thing, of course, is the introduction by the federal government to now become, in essence, equity partners for first-time home buyers up to a certain point. Was this a good thing to do from your perspective?
Yeah, from my perspective, I can see where the government is really between a rock and a hard place. Personally, from my perspective, no. You know, as industry and association in the mortgage business, we'd like to see them deal with more the fundamental issues or foundational issue of getting supply to the market faster to address affordability. Really what they've done is they're focusing on levels of indebtedness with Canadians. That is actually like very clearly the number one concern that government has is the level of indebtedness with Canadians. Mm-hmm. So by offering equity participation, they're not really entering into the markets and affecting, the price of homes, affordability directly. What they're saying
not at all.
Is not
this
at all.
doesn't do anything as far as affordability is concerned.
No, it doesn't.
Yeah.
What it does, well, it does in a sense that now you are having access to more interest-free debt from the government. So you can access more from your RSPs. You can access either 5% from the resale market or 10% for new construction to bring down the costs. So you're paying less interest. So technically you're paying less in a monthly payment. So the example the government gave was, say, a $400,000 home. You're going to be paying.
Where do you buy one of those?
Well, you can't. That's the thing. It's kind of an Ottawa-centric policy. Mm-hmm. It doesn't really work for Toronto or Vancouver or some of the larger markets.
Right.
So, but say it was a $400,000 condo, for instance, new construction. Hypothetically speaking,
yes.
Exactly. No, you're right on that, Stu. So, but what it does is it will lower the monthly payment for that borrower by about $200 a month. So, are they semantically affecting, affordability? Is it less for them, for those who participate in the program? Yes. But it's a very narrow segment of the market, and it doesn't deal with industry's concerns about getting supply to the market faster.
Which, yeah. Now, and you're not in the development industry, you're in the mortgage business.
Exactly.
So you're a mortgage broker.
Correct.
Let me take just a quick little sidebar for anybody who doesn't quite understand what the role of a mortgage broker is.
Sure.
What role do you fulfill in helping people to purchase property?
Yeah, so we're independent advisors. We work with the public, and the idea with our independence is to be able to understand what their goals are when purchasing real estate, and then finding the correct lender and the right mortgage plan to meet their long-term needs.
Mm-hmm. So are you working for that lender, or do you just find lenders that are looking to support a purchase?
So, the way I'm the company that I'm with, we're fully independent. So we're not associated with any lending institutions. So we're really here to work on behalf of the consumer and finding them the best mortgage for their needs.
So when we take a look at this latest inducement from the federal government, it's a revision. It's another way of tinkering with the B20 stress test.
Right.
You say it's not making a difference, particularly in a market like Vancouver. Will it affect anybody in the greater Vancouver, Fraser Valley region? Yeah,
so I think in the lower mainland, yes. It is possible to have new construction coming onto the market within the parameters of the new program. So I can just sidebar to the program where they say the maximum, it is designed for middle-class Canadians, so it's for incomes up to $120,000, up to maximum of 4 times that. So the ceiling from what we're seeing would be $480,000 for a purchase price. So on new construction, they would grant up to 10%. And you still have to meet the qualification with 5% down from your own resources and be able to qualify for your mortgage based on the benchmark stress test, which is still there.
So as you're explaining that, I'm going, okay, well, hang on a second. Does that apply to the
complicated.
first $480,000 in the value of the property?
No.
Or if the property exceeds $480,000, forget it. It's not on the top.
It's not. Yeah, it's not on the table.
Well, then how do I get started?
Yeah. So you would need to be.
If I can't find a place, and that's for new construction.
Correct. Yeah, well, that's for the program period. That's our understanding. So
it would be 10% for new construction, 5%
for resale.
For resale.
Yeah.
So if I managed to find something for $480,000, but it was a resale, they're only going to come in at up to 5%.
Correct. That's right. And they'll be on title with that purchaser. And the idea is that when the home is sold down the road, that 5% is reimbursed. So it's an interest-free loan is really what it is. So, it is an equity participation mortgage to help, reduce the carrying costs. So they're trying to address affordability that way. But the B20 stress test, so, by way of numbers, if we go back to last year to 2018 when the B20 stress test was introduced, it reduced buying power for first-time home buyers by about 20%.
It reduced it by 20%.
Reduced it by 20%.
Which doesn't do anything as far as affordability is concerned. As a matter of fact, it makes houses less affordable.
Yeah. So what you've done is really you haven't addressed demand because there's still demand for housing. But what you've done is you've taken more people who wanted to own out of the market. And now you've put more pressure on an already exacerbated rental market.
So Tom Davidoff at Sauder School of Business, he thinks that this new proposal of equity ownership in housing by CMHC is a good plan, that it's a good thing under the right circumstances. He actually thinks that the government could negotiate a little bit harder, and depending on the length of time that the property is owned, that the government should be getting a greater return than 10%, especially if there's an escalation in value. But despite that, he says this is a good idea. And I guess in principle, it makes sense. But if it doesn't apply to the real world.
Yeah, and I guess that's the thing is that people who live in rural communities or don't live in Vancouver or Toronto or greater the capital district of Victoria. Trying to think of other areas where you're going to struggle getting into housing for $480,000. But for the majority of Canadians, the Canadian government, and I think their numbers are accurate. Real estate sales are down across the country, and they're down, depending on the jurisdiction, could be 10 to 30%. House prices have been falling. It's not really the intended purpose of the stress test to bring housing prices down.
No, that wasn't its intended purpose at all, was it?
No, not at all. It was really to reduce the amount of debt that consumers are carrying. But the unintended consequence is that along with combined interest rates, have forced prices to come down. So you have seen about a 6% overall improvement in affordability. Now, if you take, as Tom says, new construction out in the Fraser Valley, let's say Chilliwack or Abbotsford, and you're able to buy new for $400, $480.
Maybe Mission.
Maybe Mission, right?
I know the Mission, it's a good market, yeah.
Right.
Yeah.
So, now you're getting a 10% bump in affordability, a 6% reduction in values because of the unintended consequences. You're almost back to where the stress test was. So I can see the government's claim credible in the sense that they're probably going to help another 100,000 Canadians get into housing.
Across the country.
Across the country, correct.
But not in the greater Vancouver, Fraser Valley region.
No.
and so this then becomes a challenge.
It does.
You touched on, what was the intent of the stress test. Let's go back and take a look at that. Because this was legislation that wasn't introduced initially by the Liberal government. It came in under the Conservative.
Yes, exactly.
Because they had a concern that we were overextended, and with the consequences of the 2008 meltdown in the United States, it's a legitimate concern.
Definitely.
But it's been revised.
Yes.
And so, what was the original intent? What does it become?
Yeah. So the original intent was to encourage prudent underwriting principles. So really it was, from the cautionary tale of the meltdown is what can lenders be doing now to ensure more stability? And instead of going on, a formula-based, what's the word I'm looking for here, paradigm or formula-based paradigm of, if we have so much out, we have to keep so much reserves, it was prescriptive. It became more of an active management. So where are you with your portfolio? Are you stressing your portfolio? How are your people and mortgages really doing? And making sure that if there are some risks in that portfolio, that you take corrective measures, that you set aside more reserve capital, you look at, trying to divest yourself of that type of lending in your portfolio. So making sure that you are doing everything you can. So that's, so which is reasonable.
It's prudent thinking.
It is. It is.
Yeah.
Absolutely. But with the revisions, so what they said is that despite them reducing the types of products that would be available to consumers and lenders being prudent, the debt levels were still accumulating. Predominantly, in my opinion, based on record low interest rates, because those interest rates stayed low for a very, very long time.
And there's a number of people who said that may have been one of the significant contributors to rising prices, because people had access to money. They could afford to bump up their bid.
Well, exactly, because people trade really on cash flow. It's like, how much is coming in? How much is that going to cost me? So when rates of interest, fall to record low levels, they can carry a staggering amount of debt for a relatively low payment.
Yes.
So that's exactly what we saw. So what it did then is, in the revision in 2017, B20 moved over to insured mortgages, where for people that were, first-time buyers, especially those who are vulnerable, they wanted to make sure that they weren't borrowing at their capacity, at their maximum capacity in a time of record low rates. So they made sure that they could qualify on the benchmark qualifying rate, which is about 2% higher than their actual contract rate.
So in principle, it's not a bad idea to think that way.
Yeah, I mean, it's always good for people to live below their means, right? So it did force that. And that was good for first-time buyers, because if they qualified at the benchmark rate, CMHC also limited the threshold to be $1 million for an insured purchase, so it took out some of the higher value properties. So that did have an impact on first-time buyers, and we did see the unintended consequence of that, of more people having to stay in the rental market longer before buying. But the uninsured market continued to carry on. So because it didn't stem the values and the levels of rising debt, the government decided in 2018 to revise B20 again to uninsured mortgages, what we also know as conventional mortgages. And that was the one that really hit the market, because in addition to those revisions, some of the asset-based lending that we saw, where people are sitting on large property values, banks were able to have a certain amount of flexibility in their policies and their guidelines to say, okay, well, since you have so much equity and you have income from a variety of sources, we're going to take this global income as opposed to your personal qualifying income. So that was also part of it. So qualifying at a stress test, but also now everything has to be proven based on income, not your worldwide income or whatever you're reporting in Canada. So that caught a lot of people as well.
Well, and as you point out, it then makes the cost of entry into the market more expensive for a first-time buyer.
Absolutely.
What are the long-term consequences of denying access to the real estate market to first-time buyers? Because I can't help but think, well, if you're not building equity, how are you going to get ahead in any kind of real estate market?
Yeah, well, we're starting to see that. We're starting to see people leave. There are labor shortages here in Metro Vancouver. So for people who can't really get themselves established or necessarily, get the careers they want or be able to get into housing and build equity, they go elsewhere. Right, and that's a terrible consequence for a growing economy like Metro.
Well, the other thing, and I learned this term just the other day. I thought it's a very interesting concept with the cost, where wages are at, and now the stress test and the means that are required to get into the market. We're ensuring a class of rental serfs.
Absolutely,
like, there's not a chance of getting out of that rental mix, because all these things combined prevent you from entering the ownership market.
Yeah, and that's a very valid point, Stu. And what I like about what you said there is that is exactly what's happening. So by denying the ability for people to get in because of tighter credit conditions, they are destined to stay in the rental market that much longer. And the reality is too that in Metro Vancouver here, we have about 30,000 new people arriving every year. That in itself requires 17,000 new homes to be introduced into the market. Doesn't matter if they're condos or rental units, but there's a lag, and there's also a lag on federal regulation. So I'm going to go back a little bit in time to part of this prudence with B20. Developers who want to bring units, to market, we're also told by lenders to be prudent. So before some of the banks now could give development financing for multi-unit projects, the project has to meet a certain number of pre-sale requirements.
Yes.
Right.
And that was initially designed to protect the home buyer.
Correct. Yes, exactly.
Yeah.
Yeah.
You make your deposit. It goes into trust. The developer can't touch that until they hit a certain pre-sale threshold. But that all slows down the process. And
it does. So that's the thing, is that we're now with the housing. Even though we see cranes and lots of activity, all of those units have virtually been pre-sold. It's, through a permitting process, the pre-sale requirements. I mean, we're really satisfying demand that was there 3-4 years ago. So even though it looks like things are happening, it's slow. And, while I applaud, the municipality and the provincial government for collecting additional taxes and, being, tough on foreign and, foreign speculators, as they're calling them, and these taxes are coming in, it takes time for those taxes to be collected to then be rolled out into new units for people to rent. So I think BC Housing Stat was around 3,500 units were being brought out last year.
Yeah.
But when you look at 17,000 units being needed,
it's nowhere near enough.
No, exactly.
Right.
Right.
So, not that you can write the legislation, but your wish list and the way that you would like to see this changed, just to recap, is that you say, let's turn our attention away from this and put it into supply.
Yes. Yeah. So let's get a consolidated land use plan. I mean, I do applaud the federal government for putting $2 billion in for infrastructure. That infrastructure spend could be used for transit. It could be used for land use planning. The feds are sitting on land. The municipalities are sitting on land. So is the province. Where can we get density? Where can we get infrastructure? And let's get this, these permitting processes and, community amenity contributions, like this whole process for developers to get approval now, especially in the city of Vancouver, that's taking an inordinately long time.
Yeah.
Then you have the pre-sales on top of that. That's why we're meeting demand that was there 3-4 years ago, and not the current demand.
Well, let's hope that they are rushing towards that in that direction.
Exactly.
One can hope, and there even at that there are no easy solutions right now.
Well, no. And as industry, what we'd like to see is some flexibility. I understand prudence, but 10-year mortgages now. I mean, interest rates now are starting to fall again, and we've asked the government. So we understand you don't want people to be overly leveraged. So, and the stress test is 2% above their contract rate. But if someone in a 25-year amortization is taking a 10-year term and they're first-time buyers, why can't we qualify them at the 10-year 3.99 rate? Why do we have to use 5.99? 10 years is a long time. They're going to have career growth. Their incomes are going to go up. Their maturing balance is low. So there's some common sense that we would like to see applied. And, they're listening to us, but so far they haven't done anything.
Thanks for coming in and sharing this insight.
My pleasure.
Now, we've reached out to Brad Henderson in Toronto, the CEO and president of Sotheby's Canada, who in a future episode will be sharing insights from the company's recently released report on how young Canadian families change their lifestyle and forego many things as they strive to save for a down payment on their first home. Today, however, we're focused on the impact of the federal government's tinkering with eligibility for mortgages, those being the B20 stress test and the newly introduced CMHC home buyer incentive. Welcome. Thanks for joining me from Toronto. You and your company pay an awful lot of attention to trends as far as first-time home buyers are concerned. Why is it important that we pay attention to what's happening in that first-time home buyer market?
Yeah, well, a lot of the first-time home buyers are either older millennials or younger Gen X's, and these are the people that are going to become the new affluents as they grow and develop and develop their careers. They will become the new emerging class of affluence. And as an unprecedented amount of money changes hands from the baby boom generation to that generation and other generations, they will have more wealth than they've had previously. many people will say that it's going to be the single largest transfer of wealth. So for us, we serve the market that exists today, but we're also mindful of the market that will exist in a number of years.
So what happens if these people have trouble right now getting into the housing market? What will be the consequences downstream as we see that transfer of wealth unfold?
Well, right now, the older generations are living longer, and the wealth transfer is taking a lot longer than it has in the past.
Mm-hmm.
And in the interim, because housing prices, not just in Vancouver and Toronto, but really in many cities across the globe, have increased so much, they've become more and more detached from average incomes. The catch line is that the average income earner couldn't afford the average house in Vancouver or Toronto.
Right.
And so that's frustrating what many would call the Canadian dream of home ownership. And some people thought that millennials were really more fickle than they are, and that they were not wanting to buy homes, not wanting to be attached down. They wanted to travel. They wanted to be a part of the sharing economy. And the research work that we did with the Mistel Group actually brought some light to that particular subject, because it was the case that if price was no object, if cost was no object, more millennials, more of what we're calling the young affluences, would rather own a detached home for all of the reasons that many of us have always wanted to own a home: larger space, having some yard outside, and being a part of a community. But of course, price is a factor, and that was the number one deterrent from people being able to afford homes.
So how is this affecting their lifestyle choices, their behavior, the way that they work, the way they save, what they focus on?
Yeah, it's a very important question, because more and more of their budget is going towards housing, whether it's paying mortgages or paying rent, and people are doing a number of different things in order to try and afford a home. Particularly, we noted in Vancouver that there's a lot of incidences of basement apartments where a younger person would buy a home, rent out the basement as a way to offset some of the mortgage and other costs of owning a home. Certainly, in one of the other studies we did with the Mistel Group, we found that there was a higher incidence than previously of older generations wanting to gift money to their children, specifically for the purpose of buying a home, and that had not necessarily been as big a factor 10 or even 15 years ago.
So a couple things there. You talk about renting out a basement suite as a mortgage helper, but first of all, you have to be in a position where you own the house to be able to do that. And so, what are this next generation of home buyers doing to trying to be able to even be in a position where they can afford the down payment? How is that starting to affect the quality of their lifestyle?
Yeah, again, in some of the research the Mistel Group did with us is that they are going without a lot of things, and some of the things that are easy to give up, but perhaps you could say are taking away from the quality of life is entertainment outside of the home, major purchases, cars, other larger ticket items, travel and trips are other items that they noted in the survey that they have gone without in order to be able to try and save enough money for a down payment.
Well, I noted that it pointed out that they were holding off on buying clothing or electronic devices. Like they'll let that computer go an extra year or two, even though its operating system may be falling out of date. That there's a wide variety of sacrifices that they're having to make in quality of life because the average income, as you pointed out, won't allow them to afford an average house.
Right. And so, yes, there was a long list, and the items that you mentioned were on the list, definitely not quite at the height of some of the other items that I mentioned, but absolutely they're looking at all ways to be able to have more money in savings, to be able to therefore put into a home, get into a home, and even after they're in the home, many of those items may have to be foregone. in order to make monthly mortgage payments.
So how is this contributing to new home and resale home markets right at the moment? Is it putting a damper on the market on its own, or is it part of a larger picture?
It's definitely a part of a larger picture, and I think the new affluents, if you like, are a bit frustrated by the situation, and the people that are either the older Gen Xers or the baby boomers, they're the ones who are predominantly buying, particularly the more expensive houses in places like Toronto and Vancouver, and so that is that market is reacting to different factors that are going on than just the affordability question. Certainly in Vancouver, there have been a number of well, let's take it overall in Canada, because of the federal government and OSFI tightening mortgage regulations, as well as rising interest rates. That's created headwinds for all of the markets in Canada. But specifically in Vancouver, there have been a number of provincial and municipal policies implemented, which have added additional headwinds, to the point where now the market in Vancouver in particular has seen a significant decrease in the number of homes that are bought and sold.
Well, let's start with the B20 stress test. That immediately meant that you got less of a house for what you could afford a down payment on when that came in if you were a first-time home buyer. Is it time that we revisit that policy?
Yes, well, many people have been calling for, OSFI and the federal government, because there's two different policies going on here. One is for insured mortgages, and one is for uninsured mortgages. The effect is the same, but the stress testing, when you were doubling an interest rate that was 75 basis points or 1%, is very different than an environment where interest rates are now at 1.75%, or at least the prime overnight lending rate is, and mortgage rates are considerably higher than that. And so when you're doubling it now, it's compounding the challenge, particularly that new home buyers have, but it's also causing some effect to buyers of more valuable homes. And so many are calling for the government to cap or to look at relaxing that stress testing. But the government in particular is very worried about the overall debt ratio that the average Canadian has. And so it has heretofore not really wanted to change that. So there's an argument on both sides. And I think as interest rates continue to rise, that argument will become even more heated.
So that concern from the federal government, of course, stems back to what we saw happen in the United States in 2008. But the dynamics of that market in the U.S. were considerably different than lending practices in Canada. So does the B20 stress test really address a Canadian issue? I recognize that we have to pay attention to the fact that people may have high levels of debt, but they're not the same kind of risky mortgages that we were seeing in the United States going back, 10, 11, 12 years ago.
Yeah, that's absolutely true. And you look at the Canadian banking industry, and it's dominated by the large banks. The estimate is that well over 80% of all mortgages in Canada are with the major banks, and that the average debt to ratio, how much debt a person has on average to the home, is 50%. And the default rate in Canada is very, very low. You compare and contrast that to what was happening in the United States prior to 2009, 2008, where banks were lending to customers well over 100% of the value of the home, because homes were going up so quickly. The banks figured that the mortgage would be, would start to be covered in a short period of time. And people in the United States, there's a lot of non-recourse loans, non-recourse mortgages, which means that if you do not pay your mortgage, the worst they can do is take your house. So when the financial crisis hit, what happened was that a lot of the mortgages that were out there were higher than the value of the property, the underlying. And so people walked away from their property. Yes, they may have lost some down payment or some contribution that they made to the property early on, but it was modest when compared to having to pay a mortgage on a property that isn't worth what the mortgage is worth. So that created a glut of homes on the market. That led to further increases, that led to further defaults, and so on and so on. The situation in Canada, obviously very different than what was happening then, and has become even more solidified after the financial crisis, because even though the Canadian banks weren't that affected, they took measures to de-risk their portfolio and make sure that they would be able to withstand any kind of a systemic challenge to the financial sector in Canada.
Yeah, and of course we haven't seen that happen, and so it does raise the question: do we need to take a look at the impact that the B20 stress test is having on first-time homebuyers, especially in markets like Toronto and Vancouver, where the price is pretty high, and to reach that point where you want to have enough money for the down payment, you're doing an awful lot of foregoing meals and buying new clothes and even owning a car, as you pointed out, are some of the measures that these new first-time home buyers are doing. And so then that also has a ripple out effect on the rest of the economy.
Oh, absolutely. And I think that the federal government, the Bank of Canada, provincial governments, even municipal governments have all worried about the same challenge. And certainly in Vancouver, prior to the middle of 2016, and in Toronto prior to the first quarter of 2017, the markets were unsustainable. Property values are rising in double-digit proportions on a year-over-year basis. There were multiple offers on properties. To use Chairman Greenspan's expression, irrational exuberance was taking over both in Toronto and Vancouver, and people were looking at this as a short-term speculation to make a lot of cash. So many of the policies that were put in place were intended to try and bring about a soft landing. One of the challenges that we noted early on was that they weren't really being coordinated. In other words, everyone was coming at it from their own unique vantage point, and we worried that we might overshoot the mark and actually avoid a soft landing and have more of a hard landing, which I think is a little bit more what's happening in Vancouver these days, because there are just so many different market shocks that the market is trying to absorb. So, you asked the question, should we be looking at stress testing and should we be moderating it? And there are a number of groups, the Home Builders Association and others, that are calling for that. And I do think that at some point in time, it does make sense to revisit that policy, because it's just another one of the headwinds that is not only slowing down the market, but it really isn't bringing about the goal and objective of affordability, because prices haven't really decreased. And if you want to look at a market like Calgary, where it is so hyper dependent on oil and the oil industry, there's a market where the fundamentals of that market, its GDP growth, its unemployment rate, et cetera, are all going in the wrong direction. Yet that market still has value from a real estate perspective. The rates or the value of real estate hasn't come off much more than about 10% from peak to trough. So if people are waiting for there to be a significant price correction in Toronto or Vancouver, I don't think that that's going to come about for all of the reasons we've talked about.
So the federal government seems to recognize that they need to create some kind of incentive or relief for first-time home buyers. And so in the last federal budget, they introduced measures for homes that are new and resale homes directed at those people who make less than $120,000. But when you add it all up, anybody who's wanting to buy, especially into Toronto and Vancouver, this doesn't make any difference. What was your reaction to this from the federal government during the budget?
Yeah, I think it was a good start, and I don't mean to be critical, but as you just highlighted, it isn't enough that it's going to change a lot of people's ability to buy and own a home. Also, I think there needs to be more study, because they're still working out the various policy aspects of it. because it could be the case that if you borrow that money or if you accept that money, that you're also accepting that the federal government will take part of the appreciation in your home down the road. And you can argue that that's fair, but it also will frustrate what it is that we're all trying to do in terms of solving the affordability question. I think ultimately policies that involve generating more supply is what's going to make the difference, and different kinds of supply, because right now we're lacking in terms of quote unquote the missing middle in terms of the market. So we do have very small apartments and condos and things like that can handle the very low income earners, and we have certainly the average home in Toronto, Vancouver, and higher are for other people with higher incomes or higher amounts of net worth. But for that person who's somewhere under $120,000 and is struggling to get a down payment, I think all different alternatives from a housing perspective can help, and I think different alternatives from a financing perspective can help. Some people had said, potentially reducing the stress testing for first-time home buyers or buyers of new homes, which is going to help to generate a supply of additional housing stock. And I think some of those policies have some good foundation and good thought to them, because it will help with what we're trying to do. So, again, I think it was a good start for the government. I think the fact that they're putting housing on the agenda and a housing strategy on the agenda is a good thing, because it means that Parliament will have to revisit it on an annual basis. I think also that most of the major cities are escalating the housing situation to be becoming a major policy initiative, because they recognize that if people can't afford to live in a place like Toronto, Vancouver, then increasingly they'll find employment and ultimately live in some other jurisdiction, which is not allowing the cities to grow and their tax base to grow, et cetera.
Oh yeah, the consequences of not addressing this can be far-reaching, and they can stagnate the growth of a city for decades.
Yes, absolutely.
Yeah. Well, thanks for sharing your insights with us. And please, can we invite you back in the future to take a look at how this plays itself out over time, especially if we start to see some movement in the market? What will be some of those trends?
Yeah, absolutely.
Wonderful. Thank you. Thanks for joining us.
Thank you.
All right. Bye for now. And that brings us to our final guest for this show, Tom Davidoff, who says that while the Home Buyer Incentive Program might be a blunt instrument that isn't perfect for all markets, he says Canada is much more than just Vancouver and Toronto, and says people who live in other places will benefit from what he says is an innovative idea. Tom, welcome.
Real pleasure to be here. Thanks, Stu.
There's a couple of people that we've got on this program who go, the new CMHC home and first-time home buyers incentive program, nice idea, but when it comes to Vancouver, Toronto, it doesn't really work. You maintain, despite that, this is a good idea. Why do you believe that it's a good idea?
Well, of course, there's the possibility it won't go anywhere, but I think it is a good idea for a couple of reasons. One is it doesn't have a lot of application to Vancouver and Toronto.
And you think that's a good thing?
In a way, it's a feature rather than a bug, because CMHC has some challenges. One is affordability in places like Vancouver and Toronto. People want to get into the market. They want to buy. Renting's a real challenge, so of course that's an issue. On the other hand, they're in the business of mortgage loan insurance, and they've had the alarm bells. They've got their color code of how risky each market is in terms of a possible downturn, and Toronto and particularly Vancouver's been flashing red for a while, and we're seeing the beginning of a slowdown. So they also have to be careful not to have prices go too high in Vancouver and Toronto.
Because there's very real consequences for that too.
That's right,
yeah.
And it's well, as taxpayers, should the mortgage loans go bad, we're on the hook, because CMHC, when the bank loans to an individual, a third party is CMHC, owned by the taxpayers, which says if the borrower doesn't repay the bank, the taxpayer makes up the difference. And that difference gets to be big when prices fall a lot, and prices fall a lot potentially after they've risen a lot. And making matters more intricate, prices, can be driven upwards by the presence of first-time buyers, right? Because that push from the bottom of people entering markets can do a lot to push housing prices up. Obviously, we saw that in the States in the early 2000s, and the consequences were bad both for the government and the private sector. So turning to this home loan program, it's difficult to get a place for less than $520,000 in Vancouver and Toronto, certainly downtown. With an income of less than $120,000, that's all you're going to be able to pay for, and that's been the problem. So there will be people getting in peripheral areas, and those are, of course, the buyers who are, the most in need of government support. But it is true that probably as a share of the market, this program may be smaller in Vancouver and Toronto than the rest of the country. But that's okay. In part to address what's been going on in Vancouver and Toronto, CMHC put in these stress tests over the last couple of years. Right. That makes it harder to qualify for a loan everywhere in the country. So when you're a federal entity like CMHC, it's hard to do regionally tailored policies.
But is having the stress test good policy? Is it good thinking to help protect the taxpayer, as you say, against mortgage defaults?
Well, this is where you run into the tension between you want to give those first-time buyers who want to be in the market for the long run a boost, while at the same time not having too much escalating prices. One way I like to look at it is there's a fact that's missing from this discussion, and that is when you have first-time buyers bidding on condos, who are they bidding against? If you've got
other first-time buyers,
I don't know statistically, and I'd like to know. If it's one first-time buyer against 4 baby boomers, it feels mean to tell only the first-time buyer, sorry, we're going to kind of pull the plug on your ability to borrow with this stress test. Now he can't get into the market.
Right, okay.
If it's, on the other hand, 5 millennials, all first-time buyers bidding against each other, if CMHC says, guys, you've been trying to out-jump each other to be the highest bidder, but one of you is going to get this property no matter what, we're going to tie all of your hands, and so none of you gets to bid that little bit extra by taking the 95% loan to value that you can barely make the payments on today, let alone when rates grow. So if we tie all of your hands, one of you is still going to get the property, you're just going to pay less. You're going to put the taxpayer at less risk, you're going to make lower payments down the road. The only loser is the guy who sold you the property, and that guy has been doing fine, so we're not worried.
Right.
So that's a bit of a question. So you see the trade-off of whether it's good to constrain first-time buyers or not is partly determined by the extent to which they're competing with each other. Okay.
Good point.
So I think on balance, the stress test, given where we are probably in the housing cycle, was a smart choice by CMHC. If risky loans where you can't satisfy the payment test that the stress test imposes that says you're not qualifying at today's interest rate, you're qualifying 2% higher, if it's such a great idea to lend people more money than they can qualify for under the stress test, let the private sector pick up the pace. That's fine. And then the losses are to people who know what they're getting into, and that's okay. So I think the stress test was the right choice, but the problem is it is blunt. It's a single instrument for the whole country.
Right.
And in a city like Calgary, you don't have a giant problem of home price escalation, almost the opposite. And so a first-time buyer there says, what are you doing? And the market, why are you pushing down first-timer demand and their ability to get into the market when we don't have a home price problem? Enter this home loan program, which is going to be more broadly available in places like Calgary, where you don't have a lot of $520,000 first-time buyers to the extent you do here, and so a greater fraction of the population is going to be able to use this product on a decent property. And that's a way around the stress test in a market where the stress test is less apt than in a Vancouver or Toronto. And that takes us to the feature versus a bug, that if you have more impact of pushing people into the market in places where the stress test inappropriately pushed down the market, and less impact in markets like Vancouver and Toronto, that's a feature, not a bug. Now, that's the short run. That's where we are in the cycle. In the long run, I think the real gain to this program is not what it does today in letting a few more buyers in on the margins. The real benefit is this is potentially a demonstration product.
What do you mean demonstration?
Yeah. So home ownership is a 0-1 typically. Either 0, you're a renter, you're at the landlord's mercy, and that's unpleasant, but you don't have any exposure to home prices, which is nice. You can build your own portfolio out of stocks, bonds, whatever, small business, and you don't worry about housing. But if home prices go up, it's a real problem. Alternatively, as a first-timer, you can put down 5% on the house, get a CMHC insured loan, and now the house is worth 20 times all of your savings. So you've got 2,000% or so of your wealth in a single asset. You know, your mother told you don't put all your eggs in one basket. You're putting 20 times all your eggs in a single basket. Somewhere in between would be you own a share of the house. You have control of it. There's not a landlord, but you've got an equity partner. So somebody else is taking some of the risk. It's been hard to make that work. The private sector economists have known this is a good idea for years, but it's never really taken off. Why? Investors are cautious. You know, a new product, a newfangled mortgage, borrowers are going to say, I don't know if I trust you. Investors are going to say, let me see a track record.
Yeah, and who am I investing with? Who's my partner going to be? How much are they going to try and control what we are going to or not going to do with that property?
It's a hard contract to write because if you're the equity partner of a buyer, first of all, how do you divvy up the returns? Because when you own a house, you get two things from it. You get the dividend every year of not having to pay rent. You get the rent associated with the house after taxes and expenses. And then if the property value goes up, you make extra money. If the property value goes down, you lose money. CMHC is going to take the gains and losses in home prices, but they're not going to get the dividend. So just cutting a fair deal with the borrower in that way is challenging. And then you get into, well, wait a second, what if the borrower games it a little bit? They're going to want to sell, get out, and trade up when home prices fall. When prices are rising, they're going to say, wait a second, you know, I've given up a part of my equity to CMHC. Maybe I don't want to sell now. Maybe I'll wait till prices fall. There's a worry. And the longer the borrower stays, that's more dividends that the borrower's gotten that the co-investor has not. It's a challenging product to make work, truly, but it's a potentially great idea. So I think if the government...
Because it does close that gap for people in certain markets that maybe miss out on the eligibility otherwise.
Well, think about Vancouver and Toronto, and this gets a little heavy, but today we've got interest rates on treasuries going out 10 years of less than 2% per year. Inflation of all prices is 2% per year, and I think most of us believe Vancouver and Toronto are going to grow in prices relative to apples and bananas and tomatoes over time. So that means you've got price growth and rent growth in the long run, possibly in excess of interest rates. You can't value assets in that world. It turns out if the growth of rents is greater than interest rates forever, then an apartment in Vancouver is worth infinity dollars. And the part of the value of the home that is represented by what a owner-occupier can pay for the 30 or 40 years they've got left to work, that gets small relative to the value of the condo, because the condo, or at least the land under the condo, is going to be there forever. And so in a low interest rate, high rent growth environment, it's starting to look infeasible that a lot of people are going to truly be able to buy that infinity's worth of growth discounted at a low interest rate. It may be that to get the broad middle into home ownership, to the extent that's desirable, you're going to need a deep-pocketed equity partner.
So is that a way of saying that, okay, that we're out of the gate now, and this may be the first version, but future iterations of this program may address some market-specific challenges?
It's going to be hard. Maybe the government will take losses, but if it comes out okay, investors may say, hey, this is a good idea. You know, instead of putting 5% of the value in, we'll put in 50%. So potentially this is a really great idea, and some government data may spur innovation in the private sector. If things go badly, the people who've been messing with this, and you know, the truth in reporting here, I've had conversations with people who are trying to make these products work. Should the government provide any kind of data, I think that really is valuable to innovation in the private sector. You know, it's like flying a rocket to Mars. You know, you might say, well, What do we need to be on Mars for? I just don't see the point. There's not a great point, but the spin-offs of that flight can be tremendous. You know, there's not enough innovation. When there's benefits to innovation that everybody shares in, you're not going to have enough. And government innovation can be a good thing. And I think this is an example of where it could be quite useful. So long run, it's the markets like Vancouver and Toronto that are where long-run first-time buyers are maybe getting the greatest benefits of this.
And thus we come back to the fact that you believe that this is a good start. It's innovative thinking. And the more we keep our minds open to this, especially from government agencies, maybe we're going to be able to help address some of the challenges, particularly for first-time buyers.
There's real benefits here. One, you've got some dialing back of the stress test that has the greatest impact in markets where the stress test, had the least justification. Two, you've got the long-run spillover benefits on R&D. Three, of all the ways you could have helped first-time home buyers, this wasn't bad. Now, generally speaking, if you've got a problem of too many people chasing too few homes, the solution is not throw more people into the mix. It's throw more homes into the mix.
Yes.
And the budget did have that with support for rental through investment from CMHC. So as a cyclical matter and as a supply-demand matter, that's the good part of the budget. But in an election year, there's going to be some benefits for first-time buyers who are struggling. And if you compare this to the BC program, which said, you used to be putting 5% down, and the way we're going to help you out in the face of a federal effort at stress testing is to remove that barrier and have you put 2.5% down. The BC program said, let's put less equity into homes, adding risk to the total government picture, and push more people into home ownership in the riskiest, highest priced markets. Relatively, this has the advantage of actually there's going to be a bigger buffer because it's 5% down for the taxpayer, 5% from the government, 10% in the case of a new build. So the mortgage loan is smaller, and you're still retaining that 5% down payment requirement and just slightly modulating down the stress test. So of all the gravy you could have thrown first-time buyers, I think this does relatively very little damage in terms of overheating markets.
As I hear you go through all these different variables in it, it's important to remember that navigating your way through the loan process, mortgages, CMHC, all of this is complicated. And, you're going to want to have the appropriate kind of insight and assistance from somebody who actually knows what's going on here. Relative to your particular situation. Anything that to do with the real estate market is complicated. But I'll finish off with this. You believe that this is a good start.
Bottom line, I think this is, of everything they could have done on the demand side, I think this is quite good. It doesn't exacerbate risk, and it potentially creates a demonstration product with a lot of value in Canada and elsewhere.
Great. Okay, thanks. Thanks for coming in and sharing that.
Real pleasure. Thank you.
And that wraps up today's show. Now, just before I go, I want to encourage you to take in a couple of other Vancouver Sun and Province podcasts. The first is White Towel, hosted by Paul Chapman. Paul and a series of guest hosts bring you everything you want to and need to know about the Vancouver Canucks. And for all you news junkies on all things political in Victoria, you'll want to tune into In the House, hosted by Mike Smith and Rob Shaw. I also want to give one last shout out to our sponsor. This episode comes to you thanks to the support of Denby by Sandhill. Located in Langley's historic Murrayville neighborhood, Denby is a collection of just 64 premier semi-detached townhome residences, featuring homes up to 1,100 square feet, patios that let you expand your living outside, modern kitchens, ample parking and storage, and a walkable community that lets you live, shop, and play. Check out denbyliving.com. And please join us for the public grand opening, Sunday, April the 14th, and experience Master on Main living for yourself. Thank you for tuning in on Apple Podcasts, thevancouversun.com, and theprovince.com, and on the Vancouver Sun's YouTube channel, where you'll want to be sure to subscribe because you won't want to miss an episode. As well, I want to acknowledge Arnold Chang, Greta Gibson, and Derek Hayter, without whom this show would not be possible. What a great team I get to work with. I'm Stuart McNish. Thank you for joining us on Housing Matters, the Vancouver Real Estate Show. See you next time.